Hello, welcome back to Crown SFM tutorial. Today we will be starting a new topic called business valuation. Business valuation. And in this topic, I've decided to divide the topic into two bits. I've decided to divide the topics into two bits. And the first bit, I call it explanation of key concepts. So here we try to explain the key concepts as regarding business valuation. So we look at the meaning of business valuation, we look at reasons for valuing a business, and we also look at business valuation model. Then the second bit are target computations. Computation. Under this, we look at the formulas and formats used in valuing a business, and thereafter we'll go into solving ICAN past questions. We'll go into solving ICAN past questions. So let's start right away. What is the meaning of the term business valuation? What is the meaning of the term business valuation? By business valuation, we mean the process of determining the economic value of a business. That is the process of determining the net worth of a business. Usually, we do this by getting the equity value of such business or company. Reasons for valuing a business. Reasons for valuing a business. Reasons for valuing a business. When we talk of reasons for valuing a business, there are many reasons why an entity will want to value its business. But we tend to look at it from two perspectives in line with our syllabus. While quoted companies want to value their business, why quoted company wants to value their business. For quoted company, we mean companies that are listed in the stock exchange, whereas by unquoted company, we mean companies that are not listed in the stock exchange. For companies that are not listed in the stock exchange, there are so many reasons why they may want to value their business. For instance, if the shareholders want to sell their share or buy a new share privately, they want a value to be placed on it. They want to agree on a particular price. So for that reason, they may want to value the company to know the share price. Another reason why a quoted company may want to value their business is for IPO, initial public offer. When such company wants to be listed in the stock market and they want to make initial public offer of shares, they want to know the value of their company so as to know what price to attach to their share. Another reason is why unquoted company may want to value their business could be for financial reporting reasons. For example, IFRS mandates company in terms of business combinations to get the fair value of their share, to get the fair value. So for financial reporting reasons, that is in case of like mergers, in terms of merger, business combination. Another reason is why entity may want to value their business. It could be for the purpose of additional investment or for the purpose of loan. If some unquoted company may want to secure loan from financial institution, such financial institution might require that they value the entity to know the worth of that entity before they can release such loan. Like I said, there are many reasons. There's tax reasons, there's the reasons of valuing disease estate, for example, a shareholder in case of death, in the event of death of shareholders, and we want to value the disease estate. Then for quoted companies, we know they already have share price. they already have share price. But when such quoted company may want to acquire another company which is unquoted, they may want to value that company to know the maximum amount or the price they will pay for such bid. They will pay for such bid or they will offer for such bid. That is the main reason why quoted company want to value their business. Then business valuation model. When we talk of business valuation models, and we have to explain the board right now. When we talk of business valuation model, we are talking of methods. Business valuation model. We are talking of business valuation models. We are talking of methods of valuing business or basis of valuing the business. Basis of valuing the business. In line with our syllabus, we have about five bases of valuing a company. We have about five bases of valuing a business. These are the net asset method, the income method, the cash flow method, the market value added method, and the option pricing method. There are five of them. But for this class today, we'll be dealing with mainly three of those valuation methods. The subsequent class will deal with the other two. So we'll be looking at the asset basis. We'll be looking at the asset basis of valuation. We'll also be looking at the income basis. And finally, we'll also look at the cash flow or free cash flow basis of valuation. These are the three methods we'll be looking at today. For the asset basis of valuation, this valuation model or basis tends to take this information from the statement of financial position. This is information from the state of financial position in valuing the business. So it looks at the total asset, take away the total liability. And there are about four variants of this model. We have the net asset, we have the net asset, we have the net asset historic or book value. We have the net asset historic, net asset historical or book value method, net asset historical or book value basis. We have the net asset revaluation method. We have the net asset replacement method. And finally, we have the net asset realizable method. These are the four variants of the net asset model of valuation. So I will explain each of them right now. The net asset historical or book value basis tend to look at the value of a business from the perspective of the net asset as contained in the books. That is in the statement of financial position. What are the net asset as at the date of the statement of financial position? And we know net asset is simply the total asset less total liability. That is what net asset historic or net asset book value looks at. Whereas the net asset evaluation looks at the asset from the perspective of those, looks at the value of a company from the perspective of those assets that have been revalued. When assets have been revalued, then it accommodates those assets that are revalued, they accommodate them in the computation by summing up the total asset in their new value as revalued, take away the total liability. Simple as that. Net asset replacement looks at this asset from the perspective of how much it will take to replace such asset. How much will it take to replace the asset? So, and it totals the asset and their replacement amount, take away the liability. Whereas net asset realizable looks at the value of a company from what can be realized from the asset, what can be realized, how much can be realized. And this is mainly applicable to company that is going to liquidation because the asset are sold piecemeal. So how much can we realize for this asset as of today? Such value is added together to get the total asset and then take away the total liability. And that gives us the net asset realizable. That gives us the net asset realizable. These are the asset method. These are the asset method. Income method. The income method tends to look at, it tends to take its information from the income statement. It takes information from the income statement and it looks at the market value of a company in three different variants. It looks at in any yield, which we know is earnings all over market value. And we arrive at market value using any yield by changing the subjects of this formula to market value is equals to earnings over earnings yield. Then it also looks at it from the perspective of earnings price earning ratio, which is market value over earnings. And this also will change the subject of the formula to get market value by saying market value is equal to price earning ratio multiplied by earnings. It also looks at the value of the company from dividend yield perspective, which is the same thing as dividend equal over dividend over market value. And in changing the subject formula, we get market value by saying dividend over dividend yield. This is the income methods of valuing a business. This is the income method of valuing a company. And like I said, it takes its information from the income statement. Then the third one is the cash flow basis. Is the cash flow basis, also refers to as the free cash flow basis of valuation. This cash flow basis is a regular question in SFM. What I mean that hardly do I can miss it in their exam. They love setting questions from the cash flow basis of valuation. They love setting questions from the cash flow basis of valuation. So let me wipe the board so that we can also look at the cash flow basis. Now the cash flow basis, first thing first is what is the free cash flow? Like I said, it's also called the free cash What is free cash flow? Free cash flow is said to be that cash flow that is available to be utilized at the discretion of the management after meeting all necessary obligation of the entity. And this cash flow could be utilized for the purpose of the entire firm or purpose of the entire shareholders of the firm, both debt and equity holder, or it could be utilized only for the purpose or for the benefit of only the equity holder. In that case, we call it free cash flow to equity. If the free cash flow, that the cash flow available for spending for only equity holder, we call it as free cash flow to equity. Whereas the cash flow available to both the equity holder and the debt holder, we call it free cash flow to firm. We call it free cash flow to firm. We call it free cash flow to firm. Under this cash flow method, we also have the dividend valuation model. The dividend valuation model. And dividend valuation model is grouped under this method because we see that dividend is paid in cash. This model tends to take or deal with information that relates to cash flow, information related to cash. So that is why dividend valuation model is grouped under this model. For free cash flow to firm, free cash flow to firm, because this cash flow are available to both the debt holder and the equity holder, such cash flow is usually discounted using the weighted average cost of capital or WACC in valuing the business. Whereas for free cash flow to equity, because it is available to only equity holder, it is discounted using the cost of equity. Also, dividend, of course, we know that dividend is paid to only equity holder, and such dividend valuation model is also discounted using cost of equity. These are the cash flow method. Like I said, the other method, which is market value added and offshore valuation model, will be taken in another class. So let's go into the computations. Let's go into the computations. Like I said, in the computations, first of all, we'll try to look at the formulas, then we'll go into solving past ICAN question. So for net assets, we want to look at the formula for asset-based method. We say it is net asset, and net asset, we say net asset is the total asset minus total liability. We say net asset is total asset minus total liability. It now depends on the kind of asset. If the asset is revalued, then we accommodate the revalue amount. If it is a replacement value that is given to us, then we apply replacement value. If it is realizable value given to us, we apply the realizable value in arriving at our total asset. And the same apply to liability, and with less liability, we get our net asset. Net asset, we also know that net asset also refers to as ordinary share capital plus reserve. Please note that net asset is also ordinary share capital plus reserve in the situation whereby you cannot get the asset in the statement of financial position and they give you ordinary share capital plus reserve. By the time you add them together, you have your net asset. This is the formula from the net asset method. This is the formula applicable to the net asset method. We also talk about the income. For the income method, we have stated those formulas, and talking about the cash flow method, we talk about the dividend valuation model, Under the dividend valuation model, the formula are this. For dividend that is constant, for constant dividend, the formula is market value is equals to that constant dividend or all over the cost of equity. That is it. The constant dividend over cost of equity. That is it. But if the dividend is growing, it will give us a growth rate for the dividend. Then automatically our market value, where there is growth rate, where there is growth, then our market value, the dividend valuation model becomes market value becomes the dividend year 0 1 plus the growth rate all over the cost of equity minus growth rate. Dividend year 0 1 plus growth rate all over cost of equity minus growth rate. I know we are familiar with this formula from our cost of capital class. I know we are familiar with this formula from our cost of capital class. Then, for this dividend valuation model, there are times whereby the growth rate itself it's not given, but we will have to derive it. All this we have done because of capital class. And in deriving the growth rate, there are two methods. It's either we use the historical method historical method G is equals to n root of latest dividend over earliest dividend minus 1. This is the historical method. If we want to use the historical method, where LD is equals to latest dividend and ED is equals to this is LD, ED is equals to earliest dividend ED. N is the number of year, n roots, and this is 1, it's a constant. So this is the historical method, whereby when we say historical method, they give us the history of the dividend in year 1, they give us dividend year 2, dividend year 3, so we can see the history of the dividend. We can get the dividend that was paid in year 0, we can get the dividend that was paid in the last year. So this is the historical method. Then there's the other method, which is called the Gordon growth method. Gordon growth method. The Gordon growth model. So this one, Gordon says that growth G can be derived using the formula R times B. He said G can be derived using the formula R times B. And said R is the retention ratio. That is how many percent of the earnings was retained. Retention ratios. Retention ratio. So R is the retention ratio, whereas B is the return on investment. Whereas B is the return on investment. So Gordon says in the event of multiplying this R and B, we'll get our growth rate. We have taught these things under cost of capital. Also note that this growth rate, when you are using the historical method, note with historical method, N, which is the number of years could, which is the number of years, could be n minus 1 when you cannot, when you cannot, when so for the application of the historical method, you see the formula we gave here is, we said G is equals to n root. For the application of the historical method, n root of latest dividend all over earliest dividend or minus 1. For the application of this historical method, n will also be, instead of n, you could also have n minus 1 in place of n. You could also have n minus 1, which in that case, G will be n minus 1 into the root of latest over earliest minus 1. The formula could also look like this. In the issue is, at what situation would the formula look like this or like this? In the first case, the formula for this, and the first case, this formula is applicable when we give you the dividends in years. For instance, they give you 2011, say dividend is, let's say dividend is 4 years. These are the years, this is the dividend. 2012, they give you dividend to be 5. 2013, they give you dividend to be 7, for instance. In this context, you can see clearly that the latest dividend is 7 and the earliest dividend is, the latest dividend is 7 and that is 2013, and the earliest dividend is 4, that is 2011. And you can count the year by say 2011, 2012, 2013, which gives you 3 years. In this context, you apply this to the first formula. And the second formula is applicable where they did not give you years in this manner, but in the question they just say, in the question, for instance, the question just tells you that dividend in year 1, is 6 naira, and year 4 is 15 naira, for instance. In this context, what you do is this formula. You will pick year 4, you say 4 to represent your dividend valuation model. So we go into the free cash flow format right now, and we'll be starting with the format for free cash flow to firm. Format for free cash flow to firm. This is the cash flow available to the entirety of the firm, both the shareholders and the debt holders. If we are having, these formats can come in different manners. If we are starting with EBIT, we can decide to start with EBIT, or which is earning before interest and tax, or we can decide to start with PAT, which is profit after tax. If we are starting with EBIT, what we simply do, we put our figure down according to what is given to us as the EBIT. When we tax the EBIT, that means we apply tax rate on the EBIT amount. We apply tax rate. We apply tax rate on the EBIT. Then we have our net cash flow. After our net cash flow, then we do adjustment. We add back non-cash expenses. We add back our non-cash expenses. And usually, number one of our non-cash expenses is usually depreciation and amortization. So we add them back. Any other non-cash expenses like provision, we add it back. After doing that, then we make adjustment for changes. We make adjustment for changes in working capital. So we adjust for changes in working capital. Of course, working capital, changes in working capital is different from working capital. Working capital is current asset minus current liability. For those that may have forgotten, it's current asset minus current liability. But when we talk of the changes now, we are talking of over the years, say for instance, between 2 years, what is the movement in working capital? Also know that when we are dealing with the changes in working capital, we do not recognize cash and cash equivalent because what we are trying to adjust for is cash and cash equivalent itself. Cash and cash equivalent short-term loan. So we do not recognize them. They are not part of those drivers. They are not part of those drivers that drives the result, but they are the result itself. So recognizing cash and cash equivalent in this adjustment will mean double counting to mean double counting. So cash and cash equivalent short-term loan are not recognized because we're trying to adjust for cash. So like I said, we look at the changes and not the working capital itself. We know that working capital is current asset minus current liability. We get the current asset minus current liability in year A, then current asset minus current liability in year B. What is the difference? Did they increase? Did they decrease? Of course, if current asset minus current liability, for instance, increases between 2 years, it means that we are spending more money on current assets like inventory, we are spending more money, of course, that means money is flowing out. If money is flowing out, then we are going to deduct that from our adjustment here. But if it reduces, it means we are getting more cash. And if cash is flowing in, we are adding that to our adjustment. So, in this context, changes could either be addition or subtraction. It could be addition or subtraction. The same thing applies to changes in capital expenditure. We'll try to look at changes in capital expenditure. Did we increase our capital expenditure over the years or did they reduce? Of course, this capital expenditure increase, it means we buy more of non-current asset and that means cash flows out. And if cash flows out, we deduct that. If cash is coming in, which means there are disposal of non-current asset, that means we add that back. So changes in capex will either be addition or subtraction. So whichever case, if there's increase or decrease. Also note that for changes in capex, for I always advise that you apply the T account in trying to arrive at that. If you want to get your change, you just use your normal T account for non-current asset. It will give you the opening balance, that's the balance from the previous year, you bring it down as your opening balance, and they give you the closing balance, you take it here as your closing balance. You will have the adjustment to be made in the non-current asset ledger. What adjustment do we need to make? If there's depreciation, of course, the depreciation goes to P&L, which is if it's debited. In that case, if you do this, add this and this, whatever difference you make, it becomes your cash here. And if this, for instance, is your account and this is your cash, what this means is that this account is receiving cash. And if it's receiving cash, that means cash is going out from here, you are deducting. You are deducting, which means in this context, which means there's purchase of non-current asset. Purchase of non-current asset. Purchase of non-current asset, which means there's increase in non-current asset, which means the cash is flowing out. If the other way is better for you, fine. But for me, I always advise the account, because sometimes there could be a decrease in the depreciation. If there's a decrease in depreciation, in which case that depreciation goes to the credit side of your P&L, which means it will be here in your non-current asset. That will affect it in such a way that perhaps your cash or your expense could be here, which means money is flowing in here, because rather than this account receiving money, it is giving out money. That money is coming here. So whatever way you prefer, because the other way is for you to simply take your cost, you take your current asset in 1 year, non-current asset in 1 year, minus it from the one in the other year, and usually add back depreciation. So it depends on what you prefer. So after doing this, what we arrive at is free cash flow to firm. This is the cash flow that is available to the entire firm. This is the cash flow that is available to the entire firm. If we adjust this free cash flow to firm, right now we will be doing the format of free cash flow. So format for free cash flow to equity. If we adjust the free cash flow to firm, say these are free cash flow to firm, we bring it here and we take our away interest net tax. We have this, then we either we repay loan. If we repay back debt, repay debt, of course, what does that mean to cash? If we repay debt, cash is going out. So we deduct that here. If we increase our loan, let's say we got more loans, what does that mean? More cash is coming in. We add that here. Whatever we have is free cash flow to equity. This becomes our free cash flow to equity. So if we want to value the firm, if we want to use free cash flow to firm, we can use this free cash flow and discount it using what? In which case we will have free cash flow to firm. We will discount it using what? Which in that case we have free cash flow to firm multiplied by 1 plus KW, which is y raised to power n. So we discount that, we have our value free cash flow to firm. If we do the same thing for free cash flow to equity, we discount. By discount, that means we multiply this by 1 minus minus 1 plus r, which is 1 plus k unit cos of it raised to power minus n. So we do this, we have the value of the firm. So these are the formats. Like I said, we can choose to start with net profit after tax. If we do that, the places we will try to make adjustments. If we choose to start with part, if we come here, we say part. If we have part here we will have interest net tax. We'll add back interest net tax. We'll add back interest net tax. So if we do that, then we'll do our normal adjustments that we did before. We'll arrive at free cash flow to firm. So that is how the format are. So now we stop this class here. Next class is when we do the solving of past questions. So we look for at least 3 different past questions. Look for at least 3 different past questions on business valuation ICAN so that we can solve those questions. Solve the questions. So thank you very much. See you in our next class. Please do not forget to like my channel and also share these classes for other professional accounting students. God bless you.